on the course schedule, so you may want to take a look at that when you have a chance. They're both posted in Moodle, and we'll go ahead and cover those during our live meeting on Tuesday. So today we're introducing a new topic, property dispositions, and we'll try to cover all the learning objectives related to this topic. So in starting with our learning objective 1, to calculate our gain or loss on the property disposition. For this formula, we begin with the amount that is realized. Let me just check here. Okay, so in calculating our gain or loss, we take the amount realized and we subtract our adjusted basis. So I'll explain in more detail what the two terms mean. So amount realized, we're referring to what the taxpayer has received in exchange for the sale. So let's not assume that it's always going to be cash. It could be other property. It could be that the buyer is assuming a liability that was attached to the property that we're selling. So that will have to be added as part of the amount realized. And then we're able to subtract any expenses that are related to our sale. In terms of adjusted basis, when we say adjusted basis, we're talking about the initial basis, could be the purchase price of the asset plus improvements, installation, whatever other costs we had to put the asset to use. That will be part of the basis, pretty much similar to financial accounting. And then we subtract the cost recovery allowed, in other words, our tax depreciation. Tax depreciation that we have deducted in previous years. Okay, so again, gain or loss is the amount realized less the adjusted basis. We have already stated, let me just get my handy pen, what the amount realized was and what the adjusted basis was. And here we have an example. We have, in this case, personal property. We have real property. And these assets are being used for business. So the amount realized is whatever we have received in exchange for the sale. Could be cash, could be buyer's assumption of any debt. It could be another property, the fair market value of another property received. And we have our basis, and we have depreciation, accumulated depreciation, in other words, tax depreciation that we have deducted in previous years. So we have benefited from this depreciation. So we calculate our adjusted basis, so the initial basis, let's say accumulated depreciation, that will be our adjusted basis, and compare that to the amount realized. So for item 1, for example, the machinery, we realized $300,000. Our adjusted basis is less than that amount, and therefore we have realized a gain. Here's another example for the delivery truck. Our adjusted basis is $7,500. We sold the truck for $2,000, so that means that we have realized a loss of $5,500. Now, if we have multiple items, then we will add these gains and losses, and the total amount or the net amount of gains and losses will be reported in our respective returns. Okay, so the gain or loss on disposition If we have a gain, this is going to increase the taxpayer's gross income. If we have a loss, it's going to decrease it, so we're going to benefit from that. So it's important to classify these gains and losses. Going back to this, I want to make a difference between realized and recognized. Okay, so realized means we take our amount realized less our adjusted basis and we calculate the gain or loss. That's a realized gain or loss. Now this realized gain or loss may not be necessarily recognized for tax purposes. For example, if we going back to the previous example, let me just do that. We have the machinery. We sold this machinery, or we have realized a gain on this machinery. If this was a like-kind exchange, where I have exchanged an older machinery for a new machinery, this gain that's realized may not be recognized for tax purposes. Okay. The same thing with the loss on the delivery truck. We're assuming that this delivery truck is being used for business, and therefore the $5,500 is ordinary loss. We'll go over this a little bit later. Therefore, I can deduct the full amount. But if this delivery truck was a personal use truck, I did not use it for business, I used it for commuting back and forth, it's personal use, then this $5,500 loss will not be allowed, will not be recognized. So it was realized, but it's not recognized for tax purposes. All right, so we have to be a little bit more careful. The initial basis may differ depending on the situation. Like I said, if we purchase the asset, then we made improvement to the assets, we can add that to the basis. Installation cost, delivery, etc., could be added to the basis. However, we may, for example, have inherited the basis. If we inherited from someone who passed away, a relative passed away, and we have inherited that property, then the value of that we're going to be using will be the fair market value of the asset on the date of death, or perhaps 6 months after, whatever the estate has selected. If it's a gift, depends on whether we have a gain or loss and what's the situation between the fair market value and the donor's basis. So if on the day that we receive the gift, the fair market value exceeds the donor's basis, then that's the basis that we're going to be using for our asset in the future if we're going to dispose it. If on the date of the gift the fair market value is less than the donor's basis, then it depends. If we have a gain, then we're going to use the donor's basis. If we have a loss, then we're going to use the fair market value. Okay, we talked about inherited property, so there you go. When it's converted to personal use, we have to know the fair market value of the property on that day that we are started to use the asset as for business, and usually we may use the lower of the fair market value on that day or the taxpayer's basis. Okay, so we have an example. We have a Scrap Happy on the computer. It's the 5-year makers that we're using. going back to our previous chapter where we looked at depreciation, the recovery, cost recovery, and all that. Hopefully we did not forget. We have an asset with a cost basis of 1200. If we're using financial accounting, we may be using a straight line. Okay, so this is what it will look like. For tax purposes, we have to use Maker's 5-year property. So our first year will be multiplied by 20% and so on. So we have differences between book and tax, so those are noticeable. We can see that the adjusted basis is different for book and tax. Now, of course, we're looking at tax, so that's what we're concerned about right now. In this case, our basis is 576. We sell this computer for $400. We realize a loss of 176. So if we're using this computer for business, then this loss is fully deductible because it's considered an ordinary loss. Okay, so we basically have to know what the character of the asset is, and the character is determined by its use. How are we using the asset? How long have we held this asset? So those are the two things that we need to pay attention to. Holding period, meaning if it's 1 year or less, okay, that will make a trade or business asset ordinary. If we have investment property that's been held 1 year or less, that will mean short-term capital. For inventory and accounts receivable is always ordinary regardless of the length of time that we have these assets. And why do we need to know if it's short-term or long-term capital? Why do we care about that? Because of the preferential tax rates. So if you recall, for long-term capital, we can the taxpayer can be taxed at a lower tax rate than its marginal rate. So for long-term capital gain, we have the 0, 15, and 20%. And I think if you look at previous presentations, PowerPoints, you'll see that I had the marginal tax bracket and how does that compare with the preferential rates. If we have a long-term asset, meaning held more than 1 year, and it was used for trade or business, then we have a 1231 property, and we're going to cover this a little later. So if we have an investment property, then we have long-term capital gain. And so investment property is known as Section 1221. So what exactly are ordinary assets? Where this could be inventory, receivables, machinery and equipment that we held less than a year. Okay, if you are looking at IRS form 4797, these are the assets that are listed on the page 1, part 1. So these are the assets that were held less than a year. So the sale of ordinary assets at a gain, we will have an ordinary gain, so no preferential rates there. If we have a loss on the sale, then this will be an ordinary loss that we can deduct against ordinary income without limitation. For capital assets are defined as those that are held for investment, for the production of income, or for personal use. So these could be stock, bonds, it could be land, it could be a collectible item, it could be gold. Okay, so these are capital assets. So again, it depends on how the taxpayer is using the asset. That's what makes it trade or business or a capital asset. So, of course, we would prefer a long-term capital gain because in that way we get the lower preferential tax rates as opposed to ordinary tax rates. And just a reminder that capital losses are limited to 3,000 for individuals. So if I have capital assets with a gain of 50,000 and I have losses of 60,000, I will net these so I can wipe out with my losses all of my capital gain. I will still have a loss of 10,000 left. So if I was an individual, out of that 10,000, I can only deduct 3,000 in the current year, and the remaining 7,000 will carry over to the following year. Okay, so we talked about the preferential rates. We're looking from the individual perspective. We may have unrecaptured 1250 gains. This relates to real property. If we do, these are taxed at a maximum of 25%. If we have collectibles, I mentioned before, collectible items, then those are investments. Those are, the maximum rate is 28%. And those capital gains held 1 year or less will be taxed at ordinary rates. We know about the 3,000 limitation on net capital losses. And for individuals, they can carry this loss indefinitely. Okay, corporations we're going to cover in chapter 15, so I'm just going to skip. But you can see the differences in terms of individuals and corporations. Corporations do not have the $3,000 limit, but they can only deduct capital losses up to capital gains. Okay, so now we enter into the realm of assets used for trade or business that were held more than a year. And all these assets are 1231 assets. Okay, just for the purpose that they're being used for trade or business, they're 1231 assets. Okay, let me just skip ahead. Okay, because a picture is worth 1,000 words. So a picture here, we see long-term trade or business assets. So they're held longer than a year. All of these assets are 1231. Okay. Now, losses from 1231 assets are fully deductible as ordinary losses. So if I have a business and I have a W-2 with, again, $50,000, and I have a loss generated from trade or business sale of assets of 60,000, then I will be able to fully deduct that without any limitation. So that's ordinary loss. In terms of gain, it's pure 1231 gain. So here we're talking about, sorry about this, I'm going to try to write with my pen. Okay, so we're talking about gain. Okay. If we have what we're referring here is pure 1231, meaning this is a capital asset. Okay, so the gain is 1231 is treated as capital gain. So every time we say 1231 gain, we mean capital gain. If we're talking about personal property, assets and intangibles, personal property assets doesn't mean that they're for personal use. They're actually trade or business. They're called personal property to distinguish them from real property. So personal property will be like automobiles, computers, peripherals, desks, furniture, fixtures. Some fixtures will be considered 1245. Excuse me. And so we'll go over the 1245 calculations. When we say 1245, think personal property. When we said 1250, we're talking about real property. And we said the maximum tax rate for 1250 was 25%, going back to the previous slide. Okay, so 1245 property. I'm just gonna move on to the example. I think the example is pretty good at actually thinking through the application of these different code sections and the character of the gain. So we have an example here. We have a property with the cost of 610, or actually the basis. The adjusted basis of this property is 228,658. And so depending on the amount so that means that we've taken, let me just do a quick calculation here. That means that our previous depreciation, tax depreciation taken will be, this is what happens when you try to do it. A quick calculation should be the difference between the cost and the adjusted basis. So basically we have previously deducted throughout the years 381,342. So this is our accumulated depreciation for tax purposes. It's important to keep track of that. Let me just add it here because we are going to have to recapture some of this depreciation that we have previously benefited from. So basically, we pay less taxes because we were able to deduct the depreciation. So what the government is saying, okay, you benefited from this. Now that you sold the asset, any excess, and you're going to have to kind of take this back and recognize a gain on this part that we have previously benefited from. So this will be the difference between the cost, and this is how I calculated my adjusted basis, 610,000 less the accumulated depreciation. That should equal my adjusted basis. All right. And so with that in mind, let's go to scenario number 1. We sold this asset for 300,000. So if we compare the 300,000 to the 228,650, we are saying that we're saying that we have a gain. We have a gain of 71,742 because the gain is less than the amount that we have previously depreciated. The full amount of the gain will be taxed as ordinary income. Okay, so it falls within this corridor here for the depreciation, previous depreciation that was taken. So let's go to scenario number 2. We sold the asset for 620,000. So we have realized a gain of 391,342. So up to the previous depreciation taken, that will be taxed as ordinary income, and any excess will be 1231 gain, meaning long-term capital gain. Okay, so meaning this 10,000 is subject to the preferential tax rates. The 381,342 is taxed at ordinary tax rates. All right. Now, for example number 3, we have that we sold the asset for 180. Since this is less than the adjusted basis, we have realized the loss. Automatically, when it's a loss, it's a 1231 loss. All losses are considered 1231 losses are ordinary loss and fully deductible. So again, we need to ascertain the amount of previous depreciation taken, because that's gonna determine the amount, the classification or the character of our gain. So up to any gain from 0, maybe more than 0 and 381,342 will be classified as ordinary. Any excess of that will be classified as capital gain or section 1231 gain. Okay, so we have scrap happy sells the machine with an adjusted basis of 6,000 for 10,000. Depreciation taken on the machine amounts to 2,500. What amount of gain is recaptured as ordinary, and what amount is section 1231 gain? Well, first of all, we need to figure out what the gain is. We know the adjusted basis is 6,000. We know that we sold this machine for 10. So that means we're looking at a gain of 4,000. That's correct. So we taken previous depreciation of 2,500. So this gain is going to have to be split up. Okay, so up to the 2,500 will be our depreciation recapture. This will be taxed as section 1245. And then so this will be, this part of the gain will be section 1245. Okay, that's recaptured, that's taxed as ordinary gain. And the remainder of 1,500, or the excess over the depreciation recapture, is 1231 gain. Okay, or capital. So it will be taxed at capital rates. When we're talking about real property, again, that's classified as section 1250. So if we have a gain on section 1250, then that will be taxed at a maximum of 25%. Don't worry about the corporation for now. Okay, we'll do that in chapter 15. Okay, and here we have the maximum will be 25%. Don't worry about sales to related persons. Don't worry about corporation yet. And then here we're just talking about netting our gains and losses, which we demonstrated, I think, in previous slides when we had the machinery, and we had the truck, and we had the warehouse, how it will all be compiled and summarized. So remember IRS Form 4797. This is where we report the trade or business sale of assets. For capital sales, you can use this flow chart to help you navigate through the sale of assets, and it gives you the respective rates. This is very helpful. This all is saying is we're netting. We don't need to worry about this look back rule. Let's keep it simple. We don't need to worry about, this is just an example. You can take a look at that in the book. But as we said earlier, we're just adding, we're calculating and then adding and netting all these gains and losses into one. This is the summary in the form 4797, and this is was transferred into our form 1040. For capital gains and losses, we compile those in Schedule D. So this will be for sales of stock, sales of bonds, sales of land, sales of anything that we're using as a capital investment. Okay, so make sure to take a look at the Connect assignments. Any questions, we'll discuss those on Tuesday to make the meeting more productive. Make sure to take a look at this video and also the Connect assignments. Okay, see you Tuesday.